Bitcoin's digital capital appreciating faster than the cost of capital. The cost of capital is the S&P 500 return. And then credit written against it or issued against it is digital credit. And the digital credit can have longer duration or it can have short duration. It can have higher yields. It can be in any currency because Bitcoin is a stronger currency, right? One of the keys in the credit market is if you're going to issue a credit instrument in a currency, you want it to be weaker than the collateral you hold. So if you issue the credit in a currency which is stronger than the currency you hold, you'll be upside down and you'll go bankrupt, right? And this happens, for example, when they borrow in dollars and they live in a country where the currency collapses, they're bankrupted, right? So what you want to do is you want to issue the credit in these other currencies. And so we can issue credit in yen or francs or Swiss francs or in euros or in dollars because all of those currencies are weaker than the Bitcoin currency, right? And so we discovered that we could take on any kind of currency risk. We can we can offer higher yields. We can offer yields like a distressed debt, like a company going out of business, but we can then over-collateralize them so that they look better than an investment grade. Investment grade companies in the United States aren't 2x or 3x over-collateralized. We can create 5, 6, 7, 8, 10x over-collateralized credit. So we can create credit which is less risky. We can create durations which are longer. We can create yields that are higher. And because we can create those in perpetual instruments, we can take them public. And if we take them public, then they'll have more liquidity. And so the idea is, give me something which is smarter, faster, stronger than everything else, right? Make it more liquid, make it longer duration, make it, more collateralized, make it less risky, make it higher yielding, better performing. And the opportunity of any kind of Bitcoin treasury company is you have the world's best collateral. You have Bitcoin, digital capital. If you issue digital credit, you'll have the world's best credit. And that credit will then create amplification for the equity because whatever volatility and whatever performance you strip off of the credit will accrue to the common stock shareholders. And so you create amplified Bitcoin in your equity. You create domesticated low risk, low volatility Bitcoin with yield. That thing that doesn't have cash flows, we give it cash flows, right? I mean, the irony, of course, is, a lot of these traditional credit investors, right? The people that want to invest in cash flows, they'll invest in the bonds, or they'll invest in the bonds or the equity of a company which is losing money. Or that has cash flows that don't even meet the cash flows that they're collecting, but at least it's cash flows. So what we're doing is we're giving Bitcoin cash flow. We're making it credit. That way it goes into credit indexes. And then we're creating equity, which outperforms, and that goes into equity indexes. And both of those two things raise capital. They're both gateways for capital. The capital flows into the Bitcoin ecosystem, and then we buy Bitcoin, and that finances and powers up the Bitcoin network.
Got Strife, Strike, Stride, and now Stretch. Let's break it down a little bit further. Can you just share, for a lot of people, they don't really understand what is a preferred stock. It says stock or share, but it really acts more like a credit, like a bond. You're getting a yield. So can you talk about what a preferred is? And these are specifically perpetual preferreds and how unique that is in the market.
Okay. A preferred stock is a second class of stock other than common. Common stock is you're just the final owner of the company, and you don't really have any particular preferences. You don't get any particular guarantees from the company. But if you create a preferred stock, that stock can be given a dividend yield. We can say that stock's going to pay this dividend monthly or quarterly, or it's going to pay a dividend that floats with SOFR. It could pay a fixed dividend. It could pay a variable monthly dividend. So you can give it certain cash flows and certain yielding rates. the stock can also have conversion rights. So you can say, hey, this converts to 1/10 of a share of my common stock, or 1/5 of a share, or it's fully convertible. So you can give it any amount of equity upside. You can give it any amount of yield. You can give it liquidation preferences. You can make it senior, and you can give it guarantees like it's a cumulative preferred dividend. So if we miss our dividend, we'll accumulate it. Or you can give it penalty. You can say if we miss it, we'll pay you a penalty. You can pretty much write anything into the share that you like. So there are many different types of preferred stocks. It's a generalized container. Generally, it's different than a debt instrument because a debt the principal has to be repaid at some point certain. You could make it more debt-like if you said, hey, the holder has a put right to put it back for cash. And you could make it look more like a debt instrument if you wanted, or if you basically give the holder the right to get all their cash and principal, or to redeem it. If you gave it a redemption right at some point, that would look a lot more like debt. Or you can make it look a lot more like equity if you said it's non-cumulative, like Stride is non-cumulative. So the principal never comes due, and the dividend could be suspended without a penalty or without an accumulating liability over time. So you have extremes from very, very debt-like preferreds to very, very equity-like preferreds, everything in the middle. And that just makes it a very flexible security for a public company to issue. Now, if you happen to be a public company and if you have a lot of Bitcoin, then you could create this security and then you could take it public. So the first innovation is to create a preferred. The second innovation is to take it public, and then you IPO it on like a 4-letter ticker, like STRC. And the third innovation would be, if you do take it public, you might put a shelf registration against it. And in that case, that means you might sell $1 billion of it up front, but then you might sell 50 million a week or some amount of it continuously, almost like an ETF gets bigger. Like IBIT got bigger because every single day capital flows into it, and they increase the number of shares of an ETF. So when you create a preferred that's got a shelf registration that's public, you've almost created a kind of proprietary ETF, right? You've created a new financial creature. It's got all the benefits of an ETF, but it's got also the benefits of a proprietary asset because you're creating the credit instrument in real time. You could create a preferred that is 10x over collateralized, that pays 10% dividend and it pays that forever, right? That would be an instrument, and just say, that's what I'm going to sell, and I can sell a certain amount of that. What we did was we created 4 different instruments so far. The first one we created was Strike, and the idea with Strike was, let's give people a dividend, 8% at par. Let's make it par value $100, pay an 8% dividend stream, and then give people a conversion right to 1/10 of a share of MSTR, so that, if the strategy stock is trading at $350, you have $35 worth of equity inside that instrument, right? So that was like, have some equity upside, have downside protection via the liquidation preference, and then have continuing income via the dividend. So that was a very simple, well, not a simple instrument, but an idea, which is I want the upside with very little downside, and I want yield while I'm waiting. The second instrument we created was Strife, STRF, and that was a 10% dividend yield at par. So we're going to pay 10% interest in a way, or 10% yield on a $100 instrument forever. Okay, a 100-year bond that pays 10% yield, right? You just don't see that very often. And we made that senior in the capital structure. So we basically put, as part of the security, one of the covenants in the security is we won't sell any other preferred stock senior to Strife. So Strife will always be first in preference, senior long duration credit. And that's very comforting to credit investors who are very risk averse. because they would say, well, I'm going to get paid before everybody else. So that makes my principal much better protected. And that gives me, in theory, that's credit positive. It gives it a better credit rating in their eyes. So we sold that, and that traded above par. So that traded way up. So it was yield. And the idea was, as the credit improves of our company, and as people get more comfortable with Bitcoin, as the price of Bitcoin goes up, that could go from 85 to 100 to 110 to 120 to 150. It could go to 200. So it could trade way up above par because it's totally perpetual. Then the third thing we did was we created Stride, STRD. And the idea of Stride is, what if we just sold Strife, but let's just take away the penalty clause and the cumulative effect? We literally took out like 2 clauses. And it's the same thing. It's still 10% at par. But you would say, well, this is junior long-term credit, not senior. So the senior one looks more bond-like, and you've got not a bond, but it looks less risky.
Less risky, higher in the capital stack.
Yeah, higher in the capital stack. And this looks more risky,
more
lower.
like junk.
It's just right above the equity.
Right.
So we sold that, and that trades with an effective yield of 12.7%, whereas Strife trades with an effective yield of 9%. So a 370 basis point credit spread appeared between the least risky and the most risky. And people say, and ironically, the Stride deal was twice as successful as Strife. It was twice as big. And people would say, well, why would someone want to buy that when it doesn't have a cumulative right, it doesn't have penalties, and it's junior? And the answer is because they believe in Bitcoin and they trust the company.
Yep.
And they want the yield, right? You would rather have 12.7% in your bank account than 9%. And so the issue is, do you trust your bank? If, at some point, if you trust your bank and they offer you 12 instead of 9, then you're going to do that. So now who else trusts the company? The equity holders, right? Just like who trusts Bitcoin? The Bitcoin holders.
Yeah.
At some point, you decide what you're going to trust. And this is an instrument that provided 2 benefits. Well, many benefits. One benefit is it gives people that believe in the company and believe in Bitcoin the ability to get paid 12.7% dividends. That's great for them. The second is it gives the company the ability to build collateral that's junior to the senior instrument. So it's credit positive. It's good for Strife. It's good for Strike. It's good for, everything else. And then it also gives the company a very scalable way to generate leverage to buy Bitcoin, which doesn't have credit risk. Because we bought all this Bitcoin, that means that Strife would be 50x over collateralized. Yeah. So it's actually good for the credit, good for the converts, good for the equity, good for Bitcoin, and then good for the Stride holders, right? So it's kind of the flywheel.
Yep.
And that's why we did the third. And then the last thing we did was Stretch. And the idea with Stretch was people said, yeah, I'd like to get 10% bank account instead of 5%, but I don't want the volatility. I don't want to think that maybe the principal would trade up $10 or trade down $10 a share. Like if I buy it and it's trading at 110 and then the interest rates change and it trades to 105, I'll have lost 1 year worth of interest or 1 year worth of dividends. So we wanted to find some way to get to $100 and keep this price right around par, right around 100, lowest volatility imaginable, and extract the yield. Okay, and so the idea of Stretch is, well, we don't want the duration risk. What Strife has is long duration. That means effectively 120 months of interest duration. That will cause the principal to move up and down, but below or above par a lot. In fact, 1% move in interest might cause a 20% change in principal if you have a long duration, a 20-year asset, right? So what we wanted to do was strip all the duration off. So not 120 months, we go to 1 month. And we wanted to, and when you strip the duration off, you strip the volatility off because, you know, the 30-year bond trades much more volatile than the 1 month treasury bill. So we wanted to strip the volatility off when we stripped the duration off. And to do that, we had to create a monthly instrument, not quarterly. So we basically took the dividend to a monthly cash pay, and then we had to create a variable dividend rate. So this is the first time in modern capital markets that a company created a preferred stock that has a variable monthly dividend, right? And so we call that a treasury preferred.